Okay, here we go. Welcome everyone who is attending live, of course, and then anyone who is catching the replay after the fact. Welcome to the party. Now, this live series, and by the way, in case it wasn't clear before, this series is going to last the whole week. We're doing 7 days. Okay, you don't have to attend all live, but you want to stay up to speed, meaning when we send you the replays, go ahead and watch those within a 24-hour period, just so you're always up to speed with what's going on. There's going to be a lot of information, and there are going to be a lot of what we refer to as open loops, meaning the way this whole process works doesn't always come out perfectly linearly. But that being said, if you stick with the process and you continue struggling with the questions in your brain and searching for those answers, which will provide some of them here, you're going to be okay. It's basically what I want to tell you. Now, we've got quite a varied audience here. All right. We've got some people that are brand new, meaning this might be the first time that you've ever met me, that I've ever met you. Fantastic. My name is Brandon Hofer, and I run a mastermind group of crypto investors. And our primary focus is to educate and mentor people in navigating the world of DeFi, of decentralized finance, what some people call crypto. We also have some people that I know you've been following along for a while, and maybe this is your first live call. It's been, gosh, over 3 years since I did this, the 7 day accelerator content, since I did that live. For the most part, it's been like recorded training modules and whatnot. So this might be the first time you're attending live. If that's the case, fantastic, welcome. And then I know we've also got a few people who are in the mastermind and even a few folks who are in the inner circle. Totally fine. This will be a great review. So we're going to get into the foundations here for session one, which is critical. And it's one of those things that, like, hey, people need to be reminded more often than they need to be taught. Meaning, of course, that, hey, reviewing the fundamentals, it's never not going to be helpful. Like if you are a professional NBA player, you can still shoot free throws and practice just dribbling, right? Like the fundamentals never stop being the fundamentals. So for those of you who are already kind of a little bit more advanced in the process, that's okay. You're still in the right place because this is an opportunity to review the basics and remind yourself of some of the things that are operating behind the scenes that sometimes we don't necessarily bring awareness to. So let me share my screen and we're going to dig right in. Like I said, today, make sure this is working here. There we go. Okay. So today we are talking about foundations. And actually, sorry, let me try this again. Let me share the screen here. There we go. I think that'll be better. And then I'll just pull this over. All right. So the crypto profit accelerator, and we're going to be dealing today with foundations, meaning the things that form the foundation, the basis upon which everything else we do is grounded. Okay. Now, you may have heard this one before. It's the old Chinese bamboo metaphor. But if you haven't, it basically goes like this, is that when you plant this certain species of Chinese bamboo. You put it in there, you water it, you cultivate it, and after year one, it looks like nothing's happening. And you go, oh, that's kind of weird. You water it, you cultivate after year two, it looks like nothing's happening. You keep doing this three, four. Eventually, after 5 years, you start to see the little sprouts, and you go, holy cow, all right, it's starting to work. But then year six, it starts to shoot up. And I don't know the exact number. It's like, I don't know, 6, 7, 8, 10 feet a year, something like that, something crazy. And then each year thereafter, it grows, it grows, it grows, it grows, it grows, it grows. Okay. So it could be used as an investor metaphor and compounding growth and all that good stuff. But I prefer to think of it as a metaphor for how we approach anything in life. Crypto is no exception, meaning if you focus on the foundations and you water and cultivate the foundations, at first it might not look like a lot is happening, but underneath, behind the scenes, there's a lot of growth occurring, and then you start to see the fruit of that somewhere down the road. So as we go through foundations, think of this as the Chinese bamboo approach, meaning we're planting the seeds, we're cultivating, we're watering the thing. And at the end of today's session, you might be thinking like, ah, gosh, Brandon, like what was that all about? I don't even know what to do now. That's okay because we're going to go through the tactics and the button clicking and everything else. We are going to get to that down the road. Some of you may be familiar with this model: principles, frameworks, strategies, tactics, tools, meaning there's this order to things, and everybody loves jumping in right away to the tactics and the tools. Everybody goes, which coin should I buy? Which meme coin is the best? Should I buy Pepe the Frog? Should I buy Mudang, the baby hippo? All people want to know is what's the tactic? What's the tool? But unless you have these foundations in place, your tactics and your tools are on shaky ground. They're on shallow ground, meaning you might do them for a little bit, but ultimately, big picture, they're probably in and of themselves, they're not going to get you to where you want to go. So not only do we see this in the crypto world, we see this in the online business building world, the online marketing world, right? Where people go, "Hey, I built a cool new funnel. Check out my funnel. It's amazing." And you go, "Oh, why didn't their funnel work for me?" Well, because you didn't install the foundations first. Someone goes, "Oh, I got a new video editing software." And you go, "Cool, that's what I need to help me get business." Oh, it works for a couple days and then it flops. All right. In the crypto world, this is, oh my word, I just released a new chat, not a chat bot. I just released a new trading bot. And someone goes, holy crap, the trading bot's getting 3% a day. I got to jump in on that trading bot. And what happens? Many of you have experienced this personally. It works for 2 weeks and then it flops and then you start to lose money. And you're like, why didn't that tool get me what I wanted? Well, because you missed out on the principles, you missed out on the frameworks, and you missed out on the strategies that actually fuel those tactics and those tools. Many of you know I started out years ago, over a decade ago, in the fitness industry. And again, this works across verticals, right? In the fitness industry, it was no different. People jump in and they're like, well, what supplement should I take? Well, what workout should I do? Well, I saw Brandon using kettlebells. I better start using kettlebells. And they go and try to learn a kettlebell swing and they hurt their back. And they go, oh, the kettlebells don't work for me. Well, no, it's not that the tool doesn't work for you. It's that you didn't do the work to find out what was behind the tactic and the tool so that you were better equipped to actually utilize that tactic or that tool. I had a conversation not too long ago. This was with a prospect. This was with somebody who they hadn't joined the mastermind yet. In fact, they hadn't even watched any of the training material that I had published. And at one point, and this is all via text message conversation, and at one point, we had given them a 15-minute video and it was like, hey, listen, this is going to teach you. In this case, it was the strategy. So I have a 15-minute video that outlines the strategy, just real broad strokes, kind of bird's eye view of the strategy that we use in the mastermind. And they were like, all of these YouTube videos are too long. Like, just get to the point. Meaning, hey, just give me the 30-second summary. So what does that tell me instantly? I go, you know what? This person, they're just looking for a tactic or a tool. They're just looking to resign responsibility and say, hey, just tell me the thing. Tell me what coin to buy. Tell me what to do, and then I'll be fine. And they don't understand yet, and it's okay. They don't understand yet that there's more to this. There's more of a foundation behind the scenes. And that's what we're going to get into today, laying the foundations. And this is the kind of thing, I'll tell you ahead of time, everybody wants to skip this part. Okay. So even right now, I know some of you are thinking, I could probably sit this one out, right, Brandon? No, this is the most important one. You definitely can't skip this one because if you miss out on the principles that we're going to talk about here, none of the other stuff ultimately will make sense. Okay. You might get the click by click tutorial and you go and try to do it and you go, yeah, I opened a position like Brandon did. But then you go, oh wait, what happens now? Now I don't know what to do with it. And on a deeper level, I don't necessarily know how to manage myself and my emotional volatility when I start to react to what's going on in the market. So we call this open loops. Okay. Open loops is one of the principles, one of the concepts that you'll be dealing with a lot as we dig into the world of decentralized finance. Open loops simply means, hey, when you're introduced to an idea and you don't like get it right away, your brain goes, how can I resolve this? How can I close the loop, right? So you get introduced to something and you're like, gosh, I really want to know exactly what the answer is. And we live in a world where you can just go and Google the answer. You can chat GPT the answer, right? But that's not this approach. This approach says, hey, when you're introduced to an idea, and there's a lot of ideas here in how to leverage crypto assets, how to leverage digital assets in order to create cash flow. That's what we're talking about, creating cash flow. And you go, well, I didn't even know that was a possibility. Well, how do I do it? Right? That's what your brain wants to say. I didn't even know that was possible. Just tell me how to do it. Rather, if you discover something during these sessions that you're unfamiliar with, just sit with it for a while. Go, I didn't even know there was a possibility other than buy low, sell high and trading bots and crypto mining. I didn't even know there was something else beyond that. Well, there is. And so the open loop means, hey, acknowledge that you're in a situation where there's something that you don't completely understand yet and sit with that. Like it's uncomfortable, right? Because your brain wants to resolve the dissonance that's bouncing around inside your skull. So you go, okay, let me just resolve this really quick. But instead, sit with that, let the open loop stay open, and keep coming back to these sessions because I'm going to say something today and it might not make sense until day 6. It might not even make sense until a month from now. But the point is, if you sit with it and you let it just kind of marinate and you don't try to immediately resolve it, you don't go, oh, let me Google everything Brandon was talking about and try to like stuff your brain with more ideas. No, like get the idea, sit with it, let the subconscious mind do its thing, which is just to like integrate and coordinate and consolidate all the information that you're exposed to and then trust that along the way, yes, I am going to give you the tactics. Yes, I am going to give you the tools. We are going to get to that. It's just that if we try to rush into that too soon, it really doesn't benefit you in the long term. Okay. And I put open loops plus wrecking yourself here just because if you try to go too quick, you do run a very high risk of wrecking yourself. Okay. Back to the fitness metaphor. If you see me doing kettlebell swings and kettlebell clean and press and, some of these advanced moves, the clean and jerk and the windmills and all this stuff. And you go, gosh, that looks amazing. And that guy looks fit. Like, let me try to just imitate what he's doing. And this would happen too, by the way, for real in the gym. People would like see me do stuff and I could see that they were watching me. And I'm like, okay, let's see what happens. And then they come back and they pick up a kettlebell and they try to awkwardly do it. And they go like, ah, and then like I see the grimace on their face and maybe like they touch their back, like, oh, ouch. And they would hurt themselves. Now, thankfully, they didn't absolutely wreck themselves. But the point is they would kind of injure themselves a little bit, a mild injury, and then they would give up on kettlebell training in this example. Well, what happened? All that happened was they didn't bother to first understand that it's not about the tool. Kettlebell, barbell, dumbbell. It's not about that. It's not about the tool. It's about the movement patterns and the self-awareness that form the foundation that allow you to then utilize those tools for the outcome, building strength, losing fat, joint mobility, whatever your personal outcome might be. Now, in an investor context, same idea applies. You might see someone do a demo. And I'm actually today, at the end of this session, I am going to do a demo, but I'm telling you ahead of time, don't try to do the thing that I'm about to show you on the crypto side. Okay, don't do it. Just watch it, just observe, and then sit with that open loop and go, huh, didn't know that was a possibility. That's good. Like sit with that open loop. Okay. Then later down the road, sure, you can apply it. But it's like if you see me do a kettlebell swing, don't try to do a kettlebell swing on day one. Come and learn the process. Otherwise, you risk injury. If you see me open a position on today's call, don't immediately go, I'm going to imitate exactly what Brandon just did because you're going to go and try and you might get lost. Or worst case scenario, you might succeed, but then you don't know what comes next after that. So open loops means be relaxed, understand that we're not here to like get the answer and put it into practice immediately. I am going to show you some stuff tactically, but I want you just to sit with it and just think about it. And when you go to sleep tonight, just let it rest and come back for subsequent sessions, knowing that, okay, we are going to get to that, but there needs to be some actual foundations laid before that. Now, one of these foundations is the principle of the barbell. Okay, now I know a lot of you are familiar with this. You might be familiar with Nick Peterson's teaching. You might be part of the Guardian Academy. There's a lot of great resources that emphasize this approach. This was actually, to my knowledge, popularized by Nassim Taleb, who wrote Black Swan and Anti-Fragile, and he's got this whole series of books called The Incerto. Nassim Taleb. It's actually really helpful to read through those, I found. And he's got a background in like the trader space. So same context as us. Now, someone else probably thought about this before. This goes back to like Stoic philosophy. So it's not like a new idea. It's just we're bringing it into a modern context and we're applying it here in crypto investing. Okay. So the basic premise is that a balanced barbell, and in this case, we're going to talk about investment portfolio. A balanced barbell will have something on this side that is reliable, tried and tested, and ultimately pretty low risk. Okay. And then over on the other side, we might have something a little more speculative. Did I spell that right? Speculative. And there might be some higher risk on that side. Okay. So if we took this from an investor perspective, not even in crypto, let's pull it back and say, like, okay, what would that look like in the real world? You go, well, maybe on the one side, I've got whole life insurance and real estate. That would be over here. Hey, this is pretty good. Returns are decent, but I'm not going to get 60, 70, 80% a year. I'm going to get smaller returns, but that's okay. I like to have the reliable tried and tested. And then over here, we might say, oh, but I'm going to do a little bit of day trading. I'm going to do some options, whatever it might be, something that's a little bit more speculative, a little higher on the risk side. So the idea here is that I can put more capital over on this side and less capital over here because there's asymmetric risk reward, meaning here there's not much risk, not much reward. Over here, there is a lot of risk, but there's larger rewards. But I don't have to hit the bullseye as often over here because one win might offset the losses of nine other plays over on this side. Okay. So this is one example of what a barbell strategy might look like for investing. Now, if we took the concept, we took the principle, and we apply this to crypto investing, and I promise you this is going to play in later, okay? We apply this to crypto investing, we could say, okay, I want on the one side something by crypto standards safe and reliable. So this would be blue chips. Okay, when I say blue chip crypto assets, I'm talking about the things that are highly unlikely that they'll dump to zero tomorrow. Okay, Bitcoin, easy example. Ethereum, easy example. Maybe Solana, BNB, some of these other like Chainlink. Okay, Chainlink doesn't like pump hard every year, but we know like, hey, it's been around for a while. It's kind of like slowly, steadily building. So we would look at the blue chip crypto assets and say, this could be part of my reliable side of my barbell. Now over here, what could be this one? Well, this could be your meme coins. Okay, these are just examples. This could be your meme coins where you go, you know what? I bought some Dogecoin when it was a penny and it shot up to 20 cents and I sold it off. Great, you got a 20x. You could have lost on 17 other investments in the meme coin space, and the gains from that one play on Dogecoin could potentially make up for everything else. Okay. So you can see the idea is having something balanced, allocating a larger portion of your total available capital to the safe and reliable side, and allocating a smaller total portion to the less reliable, speculative, asymmetric risk reward side. Okay. Now, what I'm going to show you is a method by which you're going to create cash flow. Okay. So, for our purposes, this side of the barbell is going to be where you can, if you choose to, and this is what I'd recommend, allocate a larger percentage of your crypto portfolio. And you're going to be participating in actions that generate cash flow, which to me is a hedged play. Okay. When I say a hedged play, what I mean specifically is this strategy is not something that will get you the highest possible return, but you are hedged. So you got a little bit of insurance in a sense, because chasing the highest possible maximum return, I'm sure some of you have experienced this, chasing it doesn't always mean you end up getting the highest possible actual return, because you're spending a larger percentage over on the other side of that barbell equation. Okay. So hedged means, hey, I can play by crypto standards, very safe and reliable. And if I do that, what we're finding in the mastermind, and this is for me personally as well as our members, you can still land between 50 and 100% APR, meaning 50 to 100% return per year on average, plus the appreciation of the underlying assets. Okay. Meaning that 50 to 100%, that's only accounting for yield, only accounting for cash flow. Now, some people, and I've had conversations with people about this before, people who were applicants to join the mastermind, they look at the 50 to 100% per year and they literally laughed in my face. And they were like, oh, Brandon, 50 to 100%, this is crypto. Like I can get 20x this year. And I'm going, okay, that's fine. Our conversation's probably over, but you're free to do it however you want, man. And they're like, well, can't you get that? I'm like, that's not my goal. Like that's not my vision for how I see this playing out. And I know ahead of time, again, the principled approach, I know if I start to pursue 20x every year with regularity, that pursuit is going to influence the tactical choices I make. And then the tactical choices that I make will, in all likelihood, it's not a guarantee, but in all likelihood, statistically, they will wreck me. Meaning I will lose more often than I gain because I'm chasing more and more and more and more and more and more. Okay. Some of you may have heard the phrase raising the floor versus raising the ceiling. It's that concept in play, meaning I don't need to chase the all-time highs. I want to more look at the higher lows that the chart is printing, because that gives me more of a foundation. Okay. So when I say 50 to 100% per year, plus you're going to get long-term asset appreciation, your actual return might very well be more than 100% per year on average. Okay. Obviously, no one can guarantee you anything in crypto, but I can tell you that even if all you ended up with, even if none of your assets grew. Let's take this one out of the equation, which I mean, it's unlikely that crypto assets just move sideways forever. But let's just play a little thought experiment, right, for the sake of illustration. Even if all I ever got was a 50% return annually, compounded yearly, that's actually phenomenal. Okay. So this goes back to like, hey, appreciate when bad things don't happen. Like, actually, I would say even if all you do in crypto is not lose, you're already ahead of almost everyone. Now, obviously, we're not here to just to not lose. We're playing to win, right? So but the idea is even if I got on the lower end of the spectrum, even if all I got was a 50% return per year annualized, well, great. If I'm patient and I can do that for 4 or 8 or even 12 years, initial starting capital of 50 grand can grow into millions at that rate. So by raising the floor, what I'm talking about is plan on the conservative estimate, 50%, rather than in your mind being like, oh, I want the 10x, I want the 20x, I want the 50x. Because when people start chasing that, again, it's not a guarantee, but the likelihood that you'll run into trouble is so much higher. So the cash flow model is a hedged play, okay? And the metaphor I like for this one is crop insurance, okay? Because the method that we're going to talk about, I'm going to show you a tactic here later. The method is some people call it farming, okay? That's a great way to think about it because it's like you're putting things in an environment that they yield something else. But when I say crop insurance, I'm talking about actual farming. So my grandfather on my dad's side, before he passed away, he had, I think it was close to like 1,000 acres in South Dakota. And then when he passed away, he obviously divided the land, gave it to the children. And so my dad got a chunk of that. And so he's been satellite farming. Now, in actual farming, what you do is you plant your seeds, and instead of just crossing your fingers, oh, I hope there's a good yield this year, a good crop, everybody gets crop insurance. So what happens is if it's a great year and you do really, really well, you celebrate and you go, yeah, bumper crop, we're selling it, prices are up, great year for farmers, awesome. But the next year, if you don't have a good year, let's say there's, for example, there's flooding and fields get flooded and the crops don't grow or the yield is like hardly anything. And you go, dang it, I just lost everything that I earned the year before because this year crops are zero. And I had to pay for the whole thing and I had to work all year and now I get zero out of it. Okay. So to avoid that, farmers gets what is called it's a literal crop insurance, okay? Meaning they're going to pay the insurance company and they're basically saying, "Hey, if there's ever a situation where this whole thing is just a wash, flooding or whatever, something bad happens, terrible weather, then you're going to still pay us a chunk." And the insurance companies go, "Great, we'll take that bet because they've got all their, profit models worked out and everything." So what happens though for the individual farmer is if they have a great year one year and then the next year it's like, meh, and they would normally have lost everything. Instead, the insurance covers them. So they might not have made as much as they made that awesome year, but they're still going to be okay and make a little bit, and it doesn't completely destroy them. So in our context, what I'm going to walk you through is the hedged model. So that you might do really great one month and you go, oh man, I got a 20% return on this cash flow. This is incredible. I'm going to get 300% on the year or whatever. No, instead you say, hey, actually, I got 20%. I'm way ahead of pace for my 50 to 100%. I got 20% in one month. Great. I'm going to pull back a little bit, hedge my plays a little bit, and invest in liquidity positions that still produce cash flow, but are on the blue chip, safe, and reliable side of crypto. Okay. So hedged means this model will not it's not about chasing highest possible return. It is about playing the game that statistically has the highest likelihood of you landing in this range consistently year over year. And that's how people win. You've probably heard this first rule of investing. I don't know if Warren Buffett coined it or if he just made it popular. First rule of investing is don't lose money. Second rule is see rule one. Okay. And as silly and trite as that sounds, there's actually really, really profound wisdom in that insight because if you set yourself up just to not lose, appreciating when bad things don't happen, if you set yourself up just to not lose, what happens is that framework, that mindset shapes all of the tactics and tools that you end up using, and it shapes the tactical decisions that you make. So you go, I could do a Sol USDC pair and average over 90% APR. Or I could do Pepe the Frog paired with ETH, and oh, it's displaying 1,000% APR right now. And so you open the position. Pepe does what meme coins do. It goes up, it goes down, what? And it tanks, and you go, shoot, I just lost 90% of what I put in. And now I gotta like fight to get back to where I was just to break even. Versus the other guy who's got the Sol USDC or Bitcoin ETH pairs over here, they're just going, yeah, this month I got 5%. I'm okay. Oh, next month I got 4%. Oh, well, I'm still winning. Like every month I'm getting more than, or rather, I'm getting closer to what my ultimate intended outcome is. Okay. So, all right, that's hedging, that's crop insurance, and reminding ourselves that, hey, even if all I do is not lose, I'm still okay. I'm still in a good position. All right. Tactical, but don't do it yet. Okay, so I'm actually gonna pull up uh, a site here. It's called Orca. It is a liquidity management tool, and I am going to click by click. I'm going to create a liquidity position. Okay, and I'll spoiler alert. I'm going to do Sol USDC. All right. Now again, we haven't gone through all of the actual like variables and things that are involved here. Okay, that's why I say don't do it yet. We didn't talk about TVL. We didn't talk about 24-hour trade volume. We didn't talk about asset selection. We didn't talk about all these variables that ultimately, like, yeah, this is not a thing where you can just say, just get to the point, Brandon. Just tell me what it is. No, like there's actually a learning curve, which is why we're doing 7 days of this, because I want you to kind of grasp these foundational concepts. Um, those things are all critical for you to be equipped to do this on your own. Okay. And in the mastermind, like this is what we guide people through. Like there's one-to-one mentorship sessions and group training, all this kind of stuff. But for most people, actually, it takes them a little bit before they get everything. But the cool thing is, you can learn the fundamentals, which I'm going to teach you during these 7 days, and you might be ready to open your first position. That's my goal. I'm not going to guarantee that you will be. All I'm going to say is, like we talked about before, don't try to do it yet. Sit with the open loops, sit with the cognitive dissonance, and then by the end of the week, go, okay, I think I understand enough to take XYZ step, whatever that might be. And it might be getting some support one-on-one. Okay. I don't know yet. Now, tactical, I don't want you to do it because this one position, I've had this one for, gosh, over a year now. Okay. It's been doing awesome. But this is one position you don't want to just dive in and like try it. You might set your range wrong. You think you might get out of range. And then what do you do when you go out of range? All that kind of stuff. Okay. But I want to show it to you now with the caveat that, hey, later in the week, what I'm about to do, because this is going to take me a couple minutes. You'll see it's quick. You'll be like, oh my word, what? That's all the time it takes. Well, yeah, that's all the time it takes once you kind of have the fundamentals in place. But when you come back for day 2, day 5, day set, like all the days, what I'm about to do will start to make more sense. Okay. And that's how we've designed this process. Like I said, it's not like linear. I can't necessarily go like, well, let's do step 1 and step 2, because there's a lot of things happening all at once. And I found the best way to teach something like this is to just put it out there, say, watch me do the thing. Then we can reverse engineer it together and go through all the little bits so you can understand the why behind the action that I just took. Okay. So let me pull this over here. There we go. Okay, so you should be able to see this. And what you are looking at right now is a site called Orca. Orca is a liquidity management platform. If you don't know what that means, that's okay. You just go, hey, that's an open loop, and you write in your notes, you go like liquidity management question mark. And what I would strongly encourage you is don't go and Google everything. tonight. Like before you start going like, ask the internet, right? And then you get 1,000 YouTube videos that are gonna like lead you down rabbit trails and take you on a completely different journey. Like instead of that, just go, you know what? Liquidity management platform, great. I don't know what that is, but I'm gonna trust that over the course of this week, I'm gonna get exposed to that along with some of these other finer details that will be involved in the entire process. So I'm going to connect my wallet. I've got my little phantom wallet here. Oops, got to put my password in. Don't look at my password. And I'm going to connect the demo account. Great. And in this demo account, I just put a couple $100, okay? Because all I'm going to do is open a position. I don't have to put in $20,000 here. This is just for the sake of demo. And we're going to be looking at percentages. Okay. So right away, I can see that this top pair right here, and these are organized by trade volume, the top pair is paying 0.28% per day. Now, that is going to fluctuate. All right. But if I just take the snapshot and extrapolate it out 0.286, and I'm not even going to do compounding just to keep the illustration as simplified as possible, I'm just going to multiply by 365. That's 104% and some change. Meaning, if I got this daily return, which doesn't seem like a lot, right? Oh, 0.28% a day, Brandon. Like what? That's not very much. But over time, it adds up to over 100%. Remember, we talked about 50 to 100% APR being our target range. If you land slightly above it, whew, just consider that a bonus. Now, I can tell you, this is in retrospect, of course, I can tell you that my Sol USDC position over an actual year got 112% APR. Okay. Very little management and maintenance on my part. I had to rebalance a couple of times. No big deal. Just a couple of button clicks. But the point is, I ended up with 112% APR. And again, that's not accounting for asset appreciation because we could go to a Solana chart and pick 2 points that are 12 months apart and go, oh, 12 months ago, Sol was at 150 and now it's pumping, but not too long ago, it was also at 150. And if we took just that snapshot of that 12-month time frame, we go, oh, Sol did nothing and I got a 0% return. But if you had been over here operating with the cash flow model, you would have also gotten 112% just from the cash flow, okay? Just from the yield that's generated from these liquidity positions. Okay, so that's just one example. And obviously we can always look in retrospect and go, oh, well, that would have happened. But the point is, okay, you could have looked in retrospect. Now we're looking forward. What is the most hedged option that puts me in a position to benefit not just from price appreciation, but also from total trade volume? Okay, this is the old metaphor of how do you get rich in a gold rush? You sell pickaxes to miners, meaning supply the tool so that you end up with a guaranteed win. So if I'm the gold miner, well, not every gold miner strikes it rich. We see the couple of people who strike it rich and go, oh my gosh, I should be chasing that. I should be chasing finding the giant gold nugget. Meanwhile, the guy who's been selling the pickaxes, he sells one pickaxe to everybody, regardless of if they win or lose, he's making money. So he sits back and goes, I didn't make as much as the guy who hit gold, but I still got closer to what I wanted. That's hedged. That's the hedged play. So Sol USDC at 0.286% APR daily, over 100% APR yearly, you might not make as much as the guy who bought Moo Dang before it went 50x. Okay. But how many people lost buying Moo Dang and Pepe the Frog and all these other silly kitty doggy froggy coins? How many people lost big because they were trying to hit it big? Okay. So by hedged play, we're going to capitalize on, and look at this 24-hour volume, 314 million. And that's low. I've seen it much higher. Meaning every single day, just on this platform, there's hundreds of millions in trade volume just on Solana for USDC, USDC for Solana. Ba, 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 ba. So there's bots, there's day traders, there's investors, there's any kind of action that goes on the chart. You are going to get a cut of that because you're going to get paid based on trade volume. You are earning a portion of the trading fees that are generated from these pairs being traded. You are metaphorically selling the pickaxe to the miner. Okay, so let's go ahead and tactical demo here. All right, I've come to Orca. I click on Sol USDC and it pulls me over to the chart here. It shows me some ranges. I can go full range or custom range. Again, we're not going to get into all the little nitty gritties right here. This is just the demo. All this other stuff, we'll talk about that later. Okay. I'm just going to set for now. Let's see where this gets me. This is going to produce a 0.31. That's even better. So I can give myself a little more cushion. Pull this up a little bit. And there we go. I now have set myself up with a position that is going to estimated pay me 0.258%. So we had a quote, right? That quote was basically just like, if you have a reasonable range based on all these factors, here's your quote. Then when you go to set up your position, you're going to get the actual estimated APR based on the parameters and variables that you set. So now I'm going to do auto swap because I've only got a little bit of SOL here. And I'm going to just put in, let's see if we do point, there we go. I'm going to put in 0.25 SOL. That's going to also give me about 19.67 USDC. So it's creating a balanced pair for me based on my range. And the total here is $60.84 that I am investing. Now, we're going to watch this unfold in real time, okay? Because I actually don't know what Solana is going to do in the next week. I'm choosing a hedged position here, okay? So Solana might go up to 194, or it might just float inside of this range. I don't know, and that's the point, is in the short term, if we're unclear on the exact market action that's going to happen, creating this kind of environment is the hedged play. So I'm going to go step one, executing trade. Great. Confirm. Thank you. We got that. And now I'm going to deposit. Confirm. Success. Now that's what I meant when I said, hey, the tactical stuff, what did that take me? Less than 60 seconds. But bamboo, right? You look at the tactical and you go, oh my word, the bamboo's growing like crazy. But you didn't see everything that happened underneath the ground, the foundations that allowed that rapid growth to happen. That's why I'm saying, look at what I did, but don't go try to do it yet. Let's take now. Here's my portfolio in real time, and we'll come back. We'll check on this, okay, later in the week, just so you can see. Okay, I've got $60 in here, and here's what I'm earning. Pending yield, not much right now because I just opened it, but every day that's going to accumulate, and we can watch the estimated yield also fluctuate, and we'll see what the actual return is based on these daily APR returns. Okay, that's a lot, but that's good. The idea for session one is to just say, hey, there's going to be a lot happening behind the scenes. We are going to get to all of it, but we can't get to all of it in one session, and we can't skip ahead to just immediately implementing tactics and tools. I showed you a tactic using one tool, but now we got to go in reverse. Okay. And so for the next couple days, we're going to be backing up, and I'm going to show you the rationale behind the actions that I just took. And again, most people don't think that they are most people, meaning no one, myself included, no one wants to admit, hey, I'm a human, I'm predictably irrational, I make silly decisions sometimes, and in all likelihood, I'm going to make decisions that put me in a place of vulnerability or risk. So the way I counteract that is to create a structure that is hedged for whatever environment that I am operating in. Okay. So that's what we're going to be doing this whole week. Strongly encourage you, like I said before, don't try to close the loop tonight. Don't be like, oh, let me go figure this out. No, just sit with it and go, it's okay. We're going to go through everything and let all the lessons slowly marinate. Human nature is like, come on, let's go. Get to the point, Brandon. Like that person that I told you about. Ah, these Zoom meetings, they're too long. Like I got to sit here for 48 minutes and learn something. No, I don't have time for that. Okay. You can do whatever you want. It's your life. But I'm here to say that if you're willing to put, and it's not a ton of time either, like just a little bit of time and effort into the learning curve and understanding how this goes. Once you get past that initial learning curve, yeah, this can be literally minutes a day. Like what I just showed you here, once you know what's what, you can literally sit down, click, 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 click it, and you're done in a couple of minutes. And then a week later, you come back, click, click, check, rebalance. Oh, another 5 minutes. Great, I'm done. And a question I often get is, well, how long does this take? Yeah, well, initially, it's going to take you some time devoted to education, but you're learning a skill that will be with you for the rest of your life because the mechanisms, the automated market makers in decentralized finance, the mechanisms upon which the strategy operates, they are not going away because they are literally the foundation of the innovation of smart contracts. Okay. So it might look different down the road, right? The tactics and tools might change, but everything else, the higher order stuff, the higher level thinking, the strategies, the principles, the frameworks, the innovation of technology, that is here for a long, long time. That is here to stay. Okay. All right. We've got a few minutes left. I booked this out for a whole hour. Got a few minutes left. Let's go to Q&A. And if there's no questions or a few questions, that's okay. I'm just opening it up. I'm saying, hey, I'm here for you. If you want to ask a few questions, you absolutely can. And then, if you're watching on the replay, maybe you have some questions too. You can drop those in the group. You can message me. You can email me, and we can address those on subsequent calls. Okay, we've got Ken. Ken wants to know, this is Ken from Michigan. What's up, Ken? Can you go over some stable coin, Sol or ETH or whatever other coin pair that can produce 50% to 75% APY? Thanks. Yeah. So Ken, and again, I'm going to answer this question, but I also want to caution you. Like this question, and granted, you asked that at 9:05, so it was before it was before I went through all the material here. But this question is tactics first, right? So you show up and you go, hey, Brandon, like I want to do a kettlebell swing. Can you show me the cool kettlebell swing? Can you show me the cool moves? Hey, Brandon, can you just tell me which pairs to open? And I actually am going to give you some examples, but I'm also going to caution you and everyone watching. The answer that I'm about to give you is tactics first. So if I give you this answer and then you go, yes, I have the formula, I have the recipe, I'm good to go. Thanks. I don't need to watch the rest of the sessions. I'm just going to go. If that's you, and I'm not saying it's you, Ken, but if that's anyone here watching on live or on the replay, if that's literally what you're thinking, you're not bad, but you've missed the point of this entire training. Okay. The point is to say, let's slow down, let's pull back, let's look at all the other higher order principles that are governing our tactical decisions, and then look at the tactical decisions. Now, that being said, I'm not going to be withholding. I'll tell you flat out, Sol USDC, awesome pair. ETH USDC or USDT, awesome pair. BNB and BUSD, awesome pair. Okay. Bitcoin, Ethereum, very awesome pair. Now, those pairs, you're probably never going to lose as long as you understand the variables, you understand which platform to invest in, you understand how to set ranges, you understand how to look at 24-hour trade volume and TVL, right? It's all the stuff that I said, hey, I just showed you the tactics. I got to show you the rationale behind those. So even though I just gave you those pairs, Ken, I would recommend you or anyone, this is not just about Ken, this is about everyone, don't just go and open those pairs right now because unless you know why you're doing it and the rationale behind it, you are opening yourself up to vulnerabilities and higher risk than you would otherwise need to expose yourself to. But the 50 to 100% APRs, those are real for those pairs, except for probably Bitcoin and ETH. If you can average 30% APR on a Bitcoin and ETH pair over time, you're actually crushing it. You're doing very, very well. Okay. Um, all right, so that's that. Renata, what is a minimum investment in crypto you would recommend? All right, and here we go again. And I'll highlight this because we're all learning, right? So you may have come to this session and this is a new concept for you. That's good. Open loop, leave it open. What's the minimum investment? That's the same question, again, fitness metaphor, that people who go, what's the best workout? I don't know what the best workout is for you. I don't know what your goals are. I don't know what your past injuries are. I don't know how much time you have. I don't know what you're really trying to accomplish big picture. So I can't tell you what the best workout is, but I can teach you some principles that will guide you in selecting a workout. Okay. Same thing here. What's the minimum investment? I have no idea what that is for you, Renata. So it could be your minimum is 10K. It could be your minimum is 500K. I don't know. I don't know how much available investment capital you have. I don't know what your other investments are. Remember, we talked barbell. So if the barbell was traditional investing, crypto investing, and then on the one side of the barbell was your crypto investing, and then we pull that out, fractal, and there's another barbell within a barbell. So this side of the barbell is crypto, and now we pull it apart. Now we get pairing meme coins, and then we pull that one out and extrapolate it again. So I don't know what that is for you because it depends on a lot of variables. Now, what I can tell you though, not minimum, maximum, or recommended, what I can tell you is an observation that I've made. And one observation that I've made, and this is from literally hundreds and hundreds and hundreds of members in the mastermind, is that for the people who are already invested in the crypto market, they tend to allocate a pretty sizable portion of their portfolio into this model. For the people who are brand new to crypto and still learning the basics, wallet setup, security, maybe they've never done anything but buy Bitcoin on Coinbase or something like that, those types of folks tend to start with between 10 and 30,000. I don't know why. It's for some reason that's like a magical number or some like, comfortable five figures. They tend to start with that. And then as they get experience investing using this model, they go, oh, okay, now I feel more comfortable. I've seen it work. Now I know what the actual returns are. I'm going to add more. But again, that could be 50,000, 100,000. I don't know. I don't know what it is for you. Now, if you're asking minimum, like what do I have to have? I mean, you just saw me make a $60 position over there. You could start with $60 if you wanted to. In fact, a lot of our mastermind members start with very like $100 or less to do what we call test positions, meaning I'm just dipping my toe in the water. Yeah, I've got a guide, but I'm still like, let me just try it out. So they'll dip their toe in the water with a little bit and then add more at another time. All right, Ken, I just purchased a Ledger Nano Plus hardware wallet. Can you show me how to connect a hardware wallet with the Phantom wallet to do a trade on Radium? That is not something, Ken, that we would do like here live on a session. But and I apologize, Ken. I don't know if you have joined the mastermind already or not. Your name looks familiar. So let me double check that and confirm. If you're already in the mastermind, then yeah, we would just get you connected on a session with your coach to do exactly that. But that's the process that you're describing, like getting one-on-one guidance. That would be something that you would get as a mastermind member. That would be one of the benefits of membership. All right. Next question. I'm not sure who this is because, oh, Raven. Raven, not Joseph Robertson. Yes. Okay. Thank you, Raven. Will you be talking about the difference between V2, V3, and I seen there's a V4 liquidity. I'm wondering what's new about V4. Thanks for looking. Yeah, V2, V3, V4, Raven, that might be a thing that we like touch on later, just V2, V3. But going through every version of what's available, that will be outside of the scope of this series because this series again is based on fundamentals and helping people take first moves. Okay. And yes, V4 is a thing. We can continue to explore that, but that would be outside the scope of this particular course. Okay, Ken, I promised to watch the remainder sessions to get the fundamentals. Yes, thanks, Ken. And I wasn't trying to pick on you, just observing the nature of your question. I might have to watch some of them on replay though, because I'm at lunch at work. Yeah, totally fine. The way we're going to do this is the replays are going to be available for 24 hours after each session. And again, that's not in the interest of withholding. It's in the interest of, hey, if we're doing this every day, you can't fall behind because what's human nature? You go, oh, I'll just wait 7 days and then get all the replays and I'll watch them next week. And then next week becomes next month and next month becomes next year. And pretty soon you have these replays on your computer and you've done nothing with them, right? Whereas this model here and in the mastermind, it's a learn by doing approach, meaning if we define intelligence as the ability to get more of what you want, well, you didn't grow and become more intelligent unless you put something into play that allowed you to get more of what you want. And in this case, probably some of that is higher returns in crypto investing. So, yeah, all that to say, yes, replays. And for anyone watching, like you got to watch them daily. So even if you miss the live session, you got to come back, you got to watch the replay on a daily basis so that you don't get behind, so that you can sit with those open loops every single day and actually learn something that you are then able to put into practice. Promise to watch the. Okay. What is the cost for joining the mastermind? We'll go over it because there's going to be a few other events and options, but I can tell you like here, just the mastermind membership, which is a 2-year membership, which includes 6 months of one-on-one mentorship. That's 9,800 to join that. Okay. So price transparency, I'm not here to withhold that, but stick around because at the end, there will be other options, not just the mastermind. Okay. We are exploring some in-person event options, which I'm really excited about because we haven't yet launched like a crypto specific in-person event. And that's something that I really want to put together. So we're going to create a wait list for that towards the end of the week, and you'll have the option to jump into that. That's going to be open for both mastermind members and folks who are just attending here the 7-day Accelerator Live. How do you manage Black Swan events? Well, short answer is you can't, but let me dig into more into that. I.e., protocol hacks are huge price divergences. Yeah, so Black Swan events are Black Swans because you can't anticipate them. All you can do is say, I can anticipate that at some point in the future, there will be a black swan, meaning I can anticipate that at some point in the future, there will be a thing that I could not have seen coming. Therefore, what do? Well, you don't manage the black swan event. Instead, you make decisions that put you in a position to benefit from time and randomness. Okay. Meaning, I'm going to create a portfolio that is hedged. And we'll get more into that later. But the idea is if I'm hedged, even if something black swan terrible happens, it might set me back a little bit, but it's not going to absolutely wreck me. Okay. And your question about protocol hacks or huge price divergences, like with protocol hacks, all you can really do is say, I'm going to choose to invest on the platforms that have already proven themselves trusted and reliable over time. Now, for me, okay, this is where it gets into opinion. For me, that means I'm not going to put a bunch of capital on a brand new exchange platform that just launched last week because I don't know if that thing's going to make it. Now, to be fair, like Uniswap could explode tomorrow too. We don't know. That could be a black swan. But in all likelihood, if I've got my capital spread out between Uniswap, PancakeSwap, maybe a little bit in Radium, maybe a little bit on Aerodrome, again, if one of those completely collapses, I might face a setback, but it doesn't absolutely wipe me out. So, how do you manage black swan events you don't? How do you prepare yourself for the thing that you can't anticipate? Hedged play, raising the floor, don't chase maximum possible upside. Look forward to tomorrow. Cool. Thanks, Jimmy. Sorry I missed the first part. There will be a different session every day, and the links will be sent out every day. Yes, Joseph, who's probably not Joseph. There will be a different session every day, so it's not just a repeat of the same thing. Every day is something new and different, and the links for replay will be sent out, and the replays will only be posted for 24 hours after the session is, or rather after we send it to you. So 24 hours after we send it to you, which will be like later this afternoon. Okay. And that's by design because I don't want you or anyone to get behind or miss out. And it takes some effort to like stay up to speed on this kind of stuff. But again, if you actually commit the time, which is it's only going to be an hour a day, You commit an hour a day, a few hours over the course of the week, you'll be in so much better of a position after you've gone through the material that all I can really guarantee and promise you is that you will be glad that you did because it will absolutely be worth it. Okay, that is all for today. I hope that you've been, I'm the real Spartacus. Okay, Anthony, the real Spartacus. I hope that you've learned something, but I also hope that you have discovered an open loop in your own brain. And I hope that you have something where you're like, I don't really get it yet, Brandon. And that's good. Like, that's okay. Sit with that. Tomorrow, it's going to make sense a little bit more. And then on Wednesday, it's going to make sense a little bit more. And then it's going to compound on itself. And at the end of the week, you're going to come back and you're going to go, oh, now I understand why Brandon clicked all of those buttons that he did on Orca and why he set it up the way that he did. Now it all makes sense because I have the foundational knowledge that showed me what's behind the scenes, what's behind the tactics and the tools. All right. Thank you, everyone, for joining us, and I look forward to seeing you at the next session. See you later.